I have mentioned on a number of occasions that we think that the course for interest rates, which so many in the United States and the financial press and the Fed think that interest rates can go down because the Fed can cut their Fed funds rate and the stated inflation numbers are going down. I continue to take the other position. And the biggest reason for that, at least in the United States, is that it's related to the enormous amount of debt that the country has, and therefore the enormous amount of financing that the Treasury multiple times a week has to auction and find buyers for over 100 billion a week in the United States, amounts that have to be raised in order to pay off the owners of those treasuries, whether it's bonds or notes or bills and so on and so forth. And as difficult as this situation is for the United States, I think there's one country where the problem is even greater, and that is in Japan. And the biggest reason for that probably is that whereas the United States is having record relationships between the amount of debt and the size of the economy, up over 120, 130%, that same ratio over in Japan is about double that, well over 200%. And in the last couple of weeks, I think probably the start may have been the Moody's position of saying, well, we no longer consider the United States to be worthy of AAA rating, the top rating. And then other related factors. We have seen the ability of the press and the administration to try to hide how difficult the financial situation regarding the bonds and interest rates is in the United States, that ability is weakening dramatically. And now you see, as a result of some of the factors, a lot more concern by even the investor and American financial analysts that want to be so bullish on the stock market and bullish on inflation going down and therefore hoping that interest rates can be cut. This is much more difficult now. And the same is happening in Japan. In Japan, a new factor has emerged, which we haven't seen in the United States, and that is the life insurance industry in Japan has caught with enormous losses of their own bond position, which has a much lower interest rate. But the life insurance industries, as I read, in Japan are caught with these enormous losses to the point where they don't want to buy any more of these bonds. And so the question for both the Japanese government and the U.S. government is, how do we deal with a situation where in both cases we have enormous supply of bonds? And the question is, who's going to buy them? And so on that basis, we continue to be very supportive for positions that we're considering: the 30-year T-bond in the United States, the puts on SOFR, the JGB 10-year Japanese bond shorting that future, and the same thing with gilts in the UK, which also has similar issues where their ability to sell bonds at the current relatively low interest rate is weakening for the similar reasons for those in Japan and the United States. However, since this cratered, talking about the 30-year T-bond prices in the last week, you have to be careful because it's clear to me that the governments are manipulating dramatically, trying to prop up the bond market, prop up the SOFR prices, keep interest rates as low as they possibly can. In the United States, probably the fact that now we've had bond yields of going over the kind of magic 5%, and we're seeing that in how the markets are acting today. I doubt that those higher prices on a daily basis, which we now see in both Japan and in the United States, can last very long. But while you see that, then I think that if you are considering taking a new position in any of these, let's say you said, okay, a new position is going to be 5 of the JGB futures, or similar number in the 30-year T-bond futures, that you start maybe by shorting 1 and ride out any further increases in bond prices for the next few days. And only when you start to make a little bit of money, same thing with the JGB in Japan, maybe it goes down a full point. Like in Japan, we're talking about the index there is like 139, and maybe it gets up as high as 140 or whatever. And only when it goes to 138, you say, all right, I'm going to now sell the second. A similar sort of a situation in the 30-year T-bond where it got down to 110, has moved up to 112. So here you are in the 112s. I would say, all right, go ahead and short one. And then maybe when it goes down to 111, you short the second one and take that kind of policy to work your way into the situation. But I think the ability in 3 to 6 months to make money by being short interest rates pretty much across the board is very, very high.